What up, YouTube? It's your boy Charles Enoch. You already know we back with another Invest in Myself episode. So run the intro. So before we get started with today's episode, make sure take a little time, hit that like button for me, hit that subscribe button for me as well. My goal is to reach 10,000 subscribers by the end of this year. So I appreciate you guys for doing that. So today I want to talk to you guys about how to pay off your credit cards by using your credit cards like a bank account. Meaning you'll be putting money onto your credit card and then drawing the money out by paying your expenses. When trying to pay your credit cards off in the most efficient way, we want to adopt the velocity banking strategy, which is income pays your credit and your credit will pay your expenses. When we're putting money onto our credit card, it reduces our interest. And if we're able to pay the statement balance off of that credit card, then we avoid interest altogether for that month. Now, once we put the money onto our credit card, it's like making a deposit. The money is not lost. We can withdraw this money by using our credit card to pay our expenses. Now, the only way this strategy works is if you have a positive cash flow, meaning the money that you bring in is more than the expenses that come out every month. So for example, if you owe $2,000 on your credit card and your income is $2,000, then you would use that $2,000 to pay your credit card off, and that will avoid interest for that month. Now, let's say your expenses are $1,500. You can then in turn use that credit card to pay your expenses. This will leave a balance of $500 left on your credit card because your cash flow is $500. So ideally, you'll pay off your credit card in 4 months because you're putting your paycheck onto your credit card, similar like a deposit, and then using that credit card to pay your expenses like a withdrawal. Now, this is a perfect scenario, and not every time you'll be able to pay your credit card off in full to avoid interest that month. But you are significantly reducing interest by putting all that money onto your credit card. So I know this may sound confusing, but you already know I have the whiteboard with an example, and we're going to break this thing down. Let's go. All right, so on the whiteboard, let's take a look at the scenario here. So it looks like our income is going to be $4,000 per month. Our expenses are going to be $3,650. And our cash flow, which is income, the $4,000 minus your expenses, the $3,650, it's going to leave you at a cash flow of $350. Now, our credit card debt, we're going to have 3 credit cards here. All of them, let's say they're going to be, the interest rate is going to be 25%. Credit card number 1 has $950 on it, and it's maxed out at $950 here. Credit card number 2 has $375 out of $600. Credit card number 3 has $570 out of $700. Now, the minimum payment per each credit card is going to be $25 each. So that's the minimum that you would have to put on it every single month. Now, our expenses, the expenses that we're going to have to pay in cash is going to be our rent, which is going to be $1,800. And then we have some type of personal loan, which is going to be $800. So a total of $2,600 out of our $4,000, we would have to use the cash to pay those 2 expenses. Now, the rest of our expenses, we're going to be paying off with our credit card here. So it looks like this individual has internet spelt wrong, but we know what we're talking about here. So internet, electric is going to be $80. Car insurance is going to be $200. Car loan, $300. Our gas is going to be $150, and groceries, $220. So that's going to equal $1,050 in expenses that we would want to pay off with our credit card. So let's take a look at the other side of the board and break this down month to month, how this method would be used. All right, so we're on the other side of the board. Let's see how this method is done here. So month 1, let's take a look here. So we're going to use cash here for our 2 most important bills here. So we're going to first pay the rent, $1,800. Remember, our income is $4,000. Doesn't matter how you get your income, monthly, biweekly, weekly, whatever. Once you get it, you're going to get put $1,800 towards the rent, keep a roof over your head. Then we're going to put $800 on a personal loan. So $2,600 out of the $4,000 of income, you're going to use cash for rent in the loan. Now the remainder of our money, $1,400, we're going to put onto our credit cards here. So let's take a look. Credit card number one, we're going to put $950 on it. That means that it's going to be paid off in full. And now when we paid off in full, it avoids the interest. So pretty much we put $950 in there. We transferred $950 in there, and it pretty much eliminated the interest for that month. Now, credit card number two, we're going to do the same thing. We're going to put $375 on there. It's going to pay it off in full. When we pay our credit cards off in full, it's going to increase our cash flow. So remember, the minimum payment for each card is $25. So increased our cash flow by $25 each of them. So $50 total. Now for credit card number three, we're going to put $75 on it. Now credit card number three, we weren't able to pay it off in full, meaning that we did not completely avoid interest, but we significantly reduced the interest on the credit card here. So I'm not going to calculate the interest for this scenario because I want to make it pretty clean, but we get the point here. So for our next step here, we're going to pay our expenses with the credit card. So we just transferred the money on the credit card. Now let's use our credit card to pay our expenses. So how we want to break it down, we have $1,050 of expenses that we need to pay for. So credit card number one, we're going to max it out. We're going to use the $950 on it. Remember, since we transferred the money in there, it avoided the interest for that month and just pushed it out. So we can max it out without paying any interest on there. And then, so we have $100 left towards expenses. So we're going to use credit card number three to pay the remainder of our expenses for this month. So when we take a look, our credit card balances are, for credit card number two, we paid it off in full and we just didn't use it. So that credit card is paid off. We're good to go. We avoided any interest. Credit card number one has $950 as a balance. But remember, since we transferred the $950 in there, we avoided interest, right? And credit card number three is going to have $595 on there. Remember, we put $75 on a balance that was $570, but then we had to pay $100 on that credit card. So it's going to leave that balance at $595 for the end of that month. All right, so let's look at month number two. We're pretty much going to be doing the same thing, but repetition until it gets beat in your head here. So month number two, what this arrow means is it's doing the same thing as month number one. So we'll break it down. Remember that we're going to use $2,600 of our $4,000 of income to first pay the rent $1,800, and then second, pay that loan $800. So we use $2,600 of that $4,000 of income. Now the remainder of our money, the $1,400, we're going to put onto our two credit cards, right? So credit card number one, we're going to pay it off in full, $950. We avoided interest, which is great. So you're pretty much just, again, transferring $950 onto that credit card, avoiding that interest. Since we paid it off in full, it increases our cash flow by $2,500 or $25 since it's an expense. It's not an expense anymore. Now, credit card number three, we're going to put $450 on the credit card. Again, we weren't able to avoid interest, but we significantly reduced that interest. Now, the next step is we're going to pay our expenses with the credit cards here. So again, it's going to be the same thing as month one here. So we're going to use credit card number one. We're going to use the full $950 to pay most of our expenses. And remember, since we transferred that money into the credit card, we did not pay interest because the statement balance is paid in full for that month. And then credit card number three, we're going to use $100 of that to pay the remainder of our expenses. So how the end of the month looks at our credit card balance, credit card number two is paid off in full. Credit card number one has $950 on it, but remember, that we did not pay interest because, again, we're just treating our credit cards like a bank account. Once we get that income, we put it in there, and then we swipe our card and pay our expenses here. And credit card number one has a balance of $245. Now, what we need to know here is, remember, our cash flow is $350. You can see that credit card going down by $300. So next month, it should be paid off. But we see that the remainder of our cash flow that we're keeping into our credit card, since we're stuffing all that money in there, is slowly going to be paying that credit card off. All right, let's look at month number 3. I think we got the hang of it, but we're going to keep going. Repetition, 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 right? So month number 3, we're doing the same thing. Once we get our income, we're going to first pay our rent $1,800 and the loan $800. So $2,600 of our cash is going to pay those two bills. Now the remainder of our money, that $1,400, we're going to put on the credit card number 1. We already know we want to pay it in full, just transfer that money in there, and then so we can avoid that interest. And then credit card number 3, we're going to actually pay that off in full now, right? And so we avoid that interest as well too. And we're going to increase our cash flow. Now we have so much money left over. We have $205 left over. Now for this next step, we're going to use $205 of our cash since we have it left over, and we're going to pay that much money onto our $1,050 of expenses. So that's going to be the first step, right? And then after that, we're going to use credit card number 1, $845, because that will be the remainder amount of expenses to pay the remainder of our expenses. So now we're not even using credit card number 3. So let's take a look at our balance now. So credit card balance at the end of month number 3. Credit card number 2 is paid in full. It's been paid in full. Credit card number 3 now is paid in full. And then credit card number 1 only has $845 on it. And remember, credit card number 1, since we paid it off in full, we avoided interest on that. All right, so let's take a look at month number 4, see what we're doing here, right? So month number 4, same thing. We're going to use our cash, $2,600, to first pay the rent of $1,800 and pay our loan of $800. Remember, those two expenses we can't pay with our credit card here, right? So we're using our cash to pay those. Now the remainder, the $1,400, we're going to first pay off the credit card here. So we're going to put $845 on that credit card to pay it off. Again, avoid that interest, right? Now we have leftover cash of $555. We're first going to put $555 and apply that towards our expenses of $1,050. Now, once we use all of our cash, then we're going to use our credit card. So we're going to use $495, which is the remaining expenses for that month, to pay off everything here. So the credit card balance at the end of the month, we're seeing credit card number 2 paid off in full, credit card number 3 paid off in full. We're not even using those credit cards anymore, right? And then credit card number 1 has $495 left on it. But remember, since we're using that as a bank account, putting our money in there and paying that statement balance off in full, we're avoiding interest, right? Now, my board's not big enough to keep going, but I think we got the scenario here. With this one card, we can continue to avoid interest for the next 2 months, and then we can pay this off. So this would be the Velocity Banking method in regards to paying off all your credit cards. And this is a more realistic scenario. Again, we did not calculate the interest in there to make it a little bit more cleaner, but you would still be doing the same process, right? So if this was helpful, definitely make sure to like and subscribe and share this video with others as well that may need to know the Velocity Banking strategy. Also, if you do have any other scenarios that you want me to do, go ahead and shoot me an email with your income, expenses, and I will do a scenario just similar to yours as well, so we can kind of keep the ball rolling and we can get something a little bit more similar to you as well. So like always, man, I appreciate you guys for tuning in. I'll see you guys next week. Peace out.